Well, good morning all. Thanks so much for tuning in once again. Last week I suggested that Michael Burry and Warren Buffett couldn't both be right about Apple, and that drew a quick response from Robert, who commented, both Burry and Warren can be right since their outlook time frame is totally different. Burry can be right for a year or two as he's interested in short term. Warren Buffett, however, can be right in 5 to 10 years in typical Warren long-term view. Now, I do love it when my viewers can point to ways in which I could reassess my position, and in this case I replied, fair comment I guess, but Burry is apparently claiming Apple is going to zero, in which case Buffett's portfolio would take a massive hit if he was not able to exit his position of 890 million shares in a timely manner. I do suspect the video titles though of the YouTube clips claiming Burry thinks Apple's going to fail are probably clickbait, so I'll defer to your more nuanced assessment on this one. Thanks for watching and adding to the conversation. Now, Robert really has hit the nail fair and squarely on the head. Burry's position or series of positions are put options, which will have a strike price and an expiry date, whereas Buffett has taken and is adding to his long-term holding in Apple. Given that Burry took his position during the first quarter of 2022, it's likely that he is actually in profit, as the share price for Apple has fallen from around $180 at the start of the year to about $140 as I record this video. But of course the reverse is also a possibility, in the sense that depending on the time until expiry of Burry's options, the value of those options would become zero if the share price of Apple rebounded in, say, a few months' time. And yet within the next few years, the actual value of Apple shares could also go to zero if the management of the company were to make some horrendously poor decisions. Now, while possible, that does seem very unlikely. Buffett's current holding in Apple should have ensured that Berkshire Hathaway would have struggled in 2022, as Apple makes up more than 40% of the Berkshire portfolio. With Apple falling by more than 21%, it's surprising though to see that Berkshire has only fallen by around about 9% compared with the S&P 500 falling by around 20%. So some of those other holdings in the Berkshire portfolio must be doing okay. A quick look at the 13F filing as at March of 31st shows that Berkshire had added to its position in Occidental Petroleum, which is up by over 100% this year, and he's also quadrupled its holding in Chevron. So Buffett has jumped onto the oil and energy train with good effect. On the other hand, quite a few of Burry's Q1 purchases have not performed as well as his position in Apple. Booking Holdings is down around 25%, Alphabet about 22%, Meta Platforms more than 50%, Global Payments down about 15 to 16%, Sportsman's Warehouse also down by a bit more than 20%, and Stellantis by over 30%, and they've all been drags on Burry's portfolio. Now, his losses on these positions are probably less than the percentage losses incurred by the companies since January 1st, but they are still substantial. The problem for investors trying to latch on to Buffett or Burry's investment decisions is that the purchase or the sale dates and the prices achieved are not disclosed in their 13F filings. As Robert suggested, Burry seems to be willing to adjust his positions quite frequently, unlike Buffett, who prefers to back his judgment of the long-term prospects of the businesses that he invests in. And of course, any investments that they make that are not listed are probably out of the reach of retail investors. So trying to mirror what they do in the hope of outperforming the S&P is a challenge beyond most of us mere mortals, I fear. So what do you do to help you make your investment decisions? Well, here's a strategy that you could try at your own peril, and I'm absolutely not recommending that you do it. Now, each day I do type in the S&P 500 into the search bar and see what pops up. There will regularly be some sort of commentary about why the market did what it did yesterday, and less frequently, but often enough, there will be some sort of forecast about what is going to happen in the next week or month. Just realign your investments to match the intent of those forecasts. Now, as I said, I'm not suggesting this is a brilliant idea. In fact, I think it's a shocker. A recent forecast, for example, that I referenced last week came from JP Morgan, who was suggesting the S&P would rise by as much as 7% in the following week. Well, the truth is that the market fell by almost 2.5%, so much for that forecast. Now, in fact, my gut feeling about these short-term predictions is that they really are a crock of hooey and should not form the basis for any logical long-term investment decision. Mind you, there could be some short-term trading opportunities for sure, but what does short-term mean to you? Is it a day? Is it a week? A month? Maybe 6 months? Maybe a year? Maybe 3 months? Whatever it is. How are you going to decide on the companies or the ETFs that are going to be the vehicles for your short-term investments? Those of you who watched Invest for the Future before it went into enforced hibernation will be well aware of my focus on stocks with strong earnings per share growth and minimal debt. And my investment decisions are triggered by changes to the financials of companies when they release their annual and their interim financial statements to the market on a 6-monthly basis. So given that I'm willing to rearrange my portfolio, say once every 6 months, I guess you could say that I take a medium-term view when assessing which companies I'll exit and which new companies I'll add to the portfolio. So perhaps that makes me more like Burry than Buffett. But in the end, it doesn't matter who I'm more like. What does matter is, will my investments deliver me a good enough return to support my preferred lifestyle? Now, over the journey, I've been guilty of making what were intended to be reasonably short-term investments in companies that had very nice share price momentum, despite the fact that they had never ever been profitable and were a very long way from passing the filters for my 3 back-tested strategies. I bought Mesoblast almost at the zenith of its share price growth, and without a strategy to exit the position soon enough, I'm now left holding that stock for a loss on paper of 89%. And having been up just over 200% on my PointsBet holding, it now sits at a paper loss of 48%. On the other hand, I did manage to squeeze out a profit of 25% from Dubber after being in positive territory to the tune of 245% in September last year. And my best result came from a touch of brilliance, I think, selling Split It at $1.46, having bought in for 66 cents a share. It closed on Friday at 14 cents. That's 92% below its all-time high. Net result of my attempts to invest in these companies where there was a hyped up story about the future potential and the outlook for the sector in which they were involved is an overall loss of $15. Sort of like makes the whole exercise a total waste of time, really. But had I been smart enough to sell within, say, 10% of their highs, the profit would have been in excess of $40,000. So the momentum would have been carrying the bulk of those stocks upwards, and I just didn't have any strategy really for deciding when it was that I was going to take profits and get out of those positions. And so my strategies for managing the trades failed me badly in all but the Split It case. I've also managed to miss all of the extraordinary gains that could have been achieved by investing early in companies like Digital Wine Ventures, Zip and Sezzle, Novanix, Megaport and Tesserant. But I would argue that the same sort of results could easily have eventuated for this basket of stocks as for the 4 great stories with no earnings stocks that I ventured into. It just depends on when you entered and how you manage the positions. Now, I have no qualms about discussing these trades from past history, as I'm not offering advice for what you should do in the future, but I do hope that they are educative in nature, and I do seriously doubt that ASIC could consider this discussion as individual personal advice to act in any particular way. But it does highlight the need for every investor, or trader for that matter, to have a very clear understanding of the risks involved in entering into any stock market investment, and to also have a very clear understanding of how that trade will be managed. Are you actually investing in the stock because you have a very positive view of its long-term prospects and you think it's trading at an acceptable price? Well, maybe that's how Burry makes his decisions, maybe not. Pretty sure though it's exactly what Buffett does. Or are you speculating on the movement in that share price based on some assessment of market sentiment, either from technical analysis or from your own interpretation of recent market commentary? Whatever the case, honestly reviewing the success of your approach to the market is very important if you are to remain in control of your investments. And just to finish for today, speaking about recent market commentary, David Bassanese, the chief economist from BetaShares, delivered a webinar on June 21 titled Bear Market Update, Equities Are Falling, Rates Are Rising, How Should Investors React? Well, I've summarised Bassanese's views from that webinar, and that summary, along with some of my general thoughts, can be found in this week's upload on my Patreon page. That additional content can be found at www.patreon.com/invest for the future. Yes, I haven't changed the title for that page, but you will find additional weekly content there should you be interested. Until I hopefully see you again next weekend, thanks so much for watching, and as always, happy investing.